Meet Vishal and Ankit, two friends who invested 10 lakh in the same mutual fund on 1st January 2016 with one simple goal. We need to stay invested for the next 10 years. Now for the first 5 years, their journey is the same. They experience the same highs and lows and the same periods of uncertainty. But after a few years of weak returns, Ankit feels the fund isn't performing well enough, so he exits halfway through. But Vishal does nothing. He sticks to his original plan and remains invested for the full 10 years. Now let's see how that one decision changed the outcome. Ankit's investment of 10 lakh rupees had grown to about 15 lakh in the first 5 years, but then he chose to exit and earned 8.4 CAGR in that period. Vishal, who remained invested for another 5 years, despite all the ups and downs, his total investment of 10 lakh became 52.6 lakh, growing at about 18% CAGR. You see, same fund, same returns, but different decisions. So here's the right way to look at it. Instead of chasing the best one-year performer, we asked a different question. Which mutual funds have survived multiple market cycles, handled years of volatility, and still delivered strong returns over the last decade? We did the homework as usual, and after going through multiple fact sheets and numbers, we have shortlisted 5 actively managed equity mutual funds that have done exactly that. And you know what the surprising part is? Not a single large cap fund made the cut. 2 of these are small cap funds and 3 are mid cap funds. For each of these 5 funds, we'll ask the exact same 5 questions so you can compare them like for like as we go. So let's get started. 1. We'll talk about size. How much money does the fund manage and does that size help it or hurt it? 2. Cost. What's the expense ratio? 3. Real returns. How much returns does the investor actually end up with? 4. Rolling returns. This is the big one. It tells us if the fund rewarded every investor regardless of when they started. And 5. Risk. Basically how bumpy was the ride and how much return did the fund actually give you for that risk. So let's get started with small cap fund number 1, Nippon India Small Cap Fund. Size-wise, this is giant. Nippon India Small Cap manages 74,600 crore. And that's a big deal because small cap stocks are hard to buy and sell in bulk without moving the price. The bigger a small cap fund gets, the harder it becomes to deploy fresh money without disturbing the stock. So managing a fund this size in this category while staying consistent is genuinely impressive. The expense ratio here is just 0.54%, which is on the lower end for this list. SIP in Nippon India Small Cap Fund would have grown to around 40.2 lakh in 10 years. Which is the highest final number on this entire list. But here's where it gets really interesting. What if Vishal hadn't started exactly 10 years ago? What if he'd started a year earlier or 2 years later, right before a crash? To answer that, we don't look at just one 10-year journey, we look at hundreds of possible 10-year journeys, starting from hundreds of different dates and see how the fund actually performed across all of them. That's what rolling returns tell us. The average rolling return for this fund was 23.37%. But forget the average. Look at how often it delivered. In 62% of all these journeys, the return was above 20% a year. In 1/3 of them, it crossed 30% a year. That's not a one-time lucky bull run across hundreds of starting points. This fund kept showing up. And only 6% of all journeys ended in a loss. That doesn't mean it never fell. Small caps always fall in rough patches. It means very few 10-year investors, no matter when they actually started, lost money. Now, small cap funds are volatile by nature. Remember in the 2018 correction, the Nifty Small Cap 100 fell nearly 32%, while the Nifty 50 actually gained around 4% in the same period. So volatility comes with this territory. Nippon's standard deviation, basically how much it returns swing around the average, is 21.56, which to be honest is on the higher side, but as expected for small caps. But its Sharpe ratio, which tells us how much return it gave for each unit of risk taken, sits within the 0.72 to 0.79 range along with the rest of our list. So despite the bigger swings, it still converted that risk into return efficiently. So big fund, low cost, highest final corpus and most importantly delivered strong returns across almost every possible starting point. That's what makes it a genuine consistent compounder, not just a lucky one. Now let's move on to small cap fund number 2, Quant Small Cap Fund. Size-wise, this is much smaller than Nippon. Quant Small Cap manages 32,739 crore. But that actually works in its favor. A smaller fund can move in and out of stocks faster and make quicker tactical calls. Expense ratio here is 0.81%. This is the highest on our entire list. Still not expensive in absolute terms, but the highest of the 5. SIP in Quant Small Cap Fund would have grown to around 37.7 lakhs, slightly behind Nippon, but still a genuinely strong outcome. Now let's look at the rolling returns, and here's where it gets interesting. Quant's highest ever rolling return touched 69.13%, which is the highest of all 5 funds on this list. When small caps were on fire, Quant captured more of that fire than anyone else. Over 30% of its rolling journeys crossed 30% annualized returns too. But here's the catch. 13.5% of all its journeys ended in a loss, more than double Nippon's number. And almost 37% of its journeys landed in a weak 0 to 10% return zone. So with Quant, when you entered mattered a lot more than with Nippon. Great timing gave you spectacular returns, but bad timing gave you a much more average outcome. Now let's look at the risk. Quant's standard deviation is 22.19. This is the highest of all 5 funds, meaning the wildest swings on this list. Its Sharpe ratio still falls within the same 0.72 to 0.79 band. This is comparable to the rest, so it did convert its risk into decent returns, but the ride itself was clearly bumpier than Nippon's. Now let's move on to mid-caps, where the whole personality of these funds changes. Fund number 3, Invesco India Midcap Fund. This is the smallest fund on our entire list. Invesco India Midcap manages just 13,790 crore. Being this size gives it a lot of flexibility to move quickly. Its expense ratio is under 0.50%, which is one of the cheapest funds on this list. Here in Invesco Midcap Fund, the SIP would have grown to around 34.96 lakh. This is the highest corpus among all 3 midcap funds, even though it's the smallest fund by size. The average rolling return comes in at 17.92%, which is lower than both the small cap funds. But here's the number that really matters. Only 2.1% of all its rolling journeys ended in a loss. That's the lowest of all 5 funds on this list by a wide margin. 39% of its journeys landed between 10 to 20% returns, another 37% between 20 to 30%. So nearly 3 out of every 4 possible 10-year journeys landed in a fairly narrow, predictable band. It barely mattered if you started 6 months earlier or later, your outcome stayed roughly the same. That's real peace of mind. Standard deviation here is 18.68. This is the lowest of all 5 funds, making it the smoothest ride on this entire list. And its Sharpe ratio is 0.79, the highest of all 5 funds. Even though its raw CAGR was lower than the small caps, it gave you more return for every unit of risk than any fund here. Now fund number 4, Nippon India Growth Midcap Fund. This is the biggest midcap fund on our list today. Nippon India Growth Midcap manages 47,415 crore, more than 3 times of the size of Invesco. Its expense ratio sits within the same 0.48 to 0.62% midcap range, still on the cheaper end compared to the small caps we talked about. The 10,000 SIP here would have grown to 34.78 lakh in 10 years, very close to Invesco's number, just slightly behind. It has an average rolling return of 17.7% and only 4.7% of its journeys landed in loss. Almost 69% of all its rolling periods landed between 10 and 30% returns. So again, no wild extremes in either direction, just steady, repeatable performance across almost every entry point. Standard deviation is 19.11, almost identical to Edelweiss, which we'll get to next, meaning both experienced a very similar degree of swings. Its Sharpe ratio also falls within the 0.72 to 0.79 band shared by the rest of the list. Now, the last fund on this list is Edelweiss Midcap Fund. It manages 16,869 crore, which is bigger than Invesco but far smaller than Nippon Growth Midcap. Expense ratio is also under 0.50%. This is one of the cheapest on this entire list. A 10,000 SIP in Edelweiss would be around 34.47 lakh, the smallest of the 3 midcap outcomes. But it still is very strong wealth creation. Rolling returns, and this is where Edelweiss surprises you. Despite having the smallest corpus among the mid-caps, it delivered the highest average rolling return in the entire mid-cap category. At 18.91%, negative journeys were limited to just 4.36%. Close to 50% of all its rolling periods generated returns above 20% annually, and nearly 15% even crossed the 30% mark. That's noticeably higher than the other 2 mid-cap funds. In other words, Edelweiss managed to capture more of that small cap style upside without giving up mid cap style stability. Standard deviation is 19.13, which is almost identical to Nippon Growth Mid Cap, confirming both funds went through a similar level of ups and downs. Its Sharpe ratio almost sits again in the same range as the rest. Okay, now let's bring all the 5 funds together. On paper, small caps won. Nippon India small cap and Quant small cap gave around 20 to 21% a year. Higher returns of small caps win. Simple, right? Except it's not that simple. Because the moment we checked what would have happened if Vishal, let's say, had started on a different day using rolling returns, the picture changed. Nippon rewarded him almost no matter when he started. Quant could hand him the best return on this entire list, but it also had the highest chance of a loss. So with Quant, timing decided everything. The mid-caps, on the other hand, barely cared when Vishal started. Invesco lost money in only 2.1% of all possible journeys, which is the safest number on this list. Nippon Growth Mid-Cap and Edelweiss weren't far behind. Lower returns, yes, but a far more predictable ride. And here's the twist that changes everything. Once you adjust for how much risk each fund actually took using the Sharpe ratio, Invesco India Mid-Cap comes out on top of all 5 funds. Small caps included. And across all 5 funds, that risk-adjusted score barely moves, staying between 0.72 and 0.79. Meaning once you account for the bumps along the way, all 5 funds were almost equally good at turning risk into reward. So small caps gave better returns, but only if the timing was right. Mid caps gave slightly less money, but almost guaranteed a smooth, predictable outcome no matter when someone started. And that's really the whole lesson. Don't just chase the fund with the highest return on screen. Ask instead, would this fund have worked for me on any day I could have started, not just the perfect one. Because these 5 funds didn't win by having one great year, they won by showing up cycle after cycle for 10 straight years. And most importantly, be Vishal, not Ankit. And no Ankits were harmed during filming this. Now tell us in the comments if you would want us to cover mutual funds more regularly and what are some topics you would want us to dive deeper in. If you found this video helpful, then do give it a like, share it with both the Vishals and Ankits of your group and subscribe because we do a lot of insightful deep dives for all the investors out there. See you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.